Evening everyone, hope you're all doing well. I've got another version of this week's Ask Me Anything, or another episode rather. Principle's really simple. You drop me a message via any of the social media channels and I will do my best to answer it. This week it's one question and it pertains to investing, and I've just read it before I went live, so I'll paraphrase it back to you. Essentially, got a situation where an individual has mortgage, modest amount of savings, no real debt. Question was, if I give you £10,000, what would you do with it? I understand that investing is a thing and I'm aware of it, but I don't know about it. Grateful for your thoughts. So I think first of all, the health warning is that, of course, clearly I can't recommend you an individual product for lots of reasons, but one of the main ones, of course, is I can only go off what you give me in a message, and that perhaps isn't comprehensive enough to go down the road of full product recommendations. So it's absolutely not a particular product recommendation, but I'll give you a general basic premise about if I was in your position, what would I do if you gave me the £10,000? A really clear, really good opportunity for people to tell me their thoughts if they agree with me or not. I think first of all, a couple of things that we need to think about. First of all, of course, is your time horizon. How long do you want to lock this money up for? You've indicated that you can probably do that for a little bit of time. And how much risk tolerance are you willing to take, i.e. how much volatility can you emotionally withstand when you commit to an investment? That's the first one. I think the second one we need to think about is, what's your hope with respect to the returns on this investment? Now, clearly an investment is really any time that you lock your money away in something with a view that eventually it will go up and you'll get back more than you put in. I would suggest to you, humbly, that your minimum target return needs to be somewhere in the region of 6 or 7%. And the reason I would say that to you is because if you're not generating a return of at least 6% or more, and 6% is the absolute minimum, by the way, it's no longer worth the volatility. At that point, you're better off just taking the cash, sticking it in a high interest account and let it do its thing. You've got to be looking for at least 6 or 7%, okay? So with that in mind then, let's go on to what I would do with this £10,000, noting that I'm looking for 6 or 7%. You've indicated that you don't necessarily know too much about investing, and that's fine. And that means if I was in your position, I would be looking more towards something called index funds. Now, an index fund is not like an individual company. It is a collection of them. So the good thing is you don't have to manage the fund. You don't have to do anything with it. An example, in the UK, we have something called the FTSE 100. That is a collection of the 100 biggest companies on the UK stock market. The American market has something similar called the S&P, Standard & Poor 500. That's the 500 biggest companies on the American stock market. And that actually averages an annual return, that particular index, of about 10% a year on average over an extended period of time. And that in reality means that because it's so big and because of the returns it generates, the S&P 500 is the benchmark that we need to assess all of our other investments against, okay? So, in other words, yes, I said you want to get a minimum of 6 or 7%, but the reality is there is an index fund out there that is very low cost, that is zero maintenance to you, and you can put it in there and generate 10 on average over an extended period. So the question you need to ask yourself is, if I'm going to not put my money in the S&P 500, it needs to do one of two things, right? It needs to either generate me a greater return, and by generating a greater return, I might have to accept that there is more volatility, or it's not going to generate me an equal to or greater return than that 10% every year. But in return for not doing that, it is less volatile, and therefore from an emotional perspective, it is something that is more palatable to me, okay? Because you need to think about your own personal risk appetite and emotional well-being when you're doing this as well. So that's what I would do. I would look for index fund or a collection of index funds, you've got £10,000. So in reality, that's anywhere between, realistically, one, no more than three, I would suggest, index funds. Otherwise, you're just diluting that investment too much. If you're in the UK, I would absolutely be putting that into a stocks and shares ISA, because that is the vehicle by which you can generate all of those returns tax-free. So you could pick an investment, come back a few years later, and hypothetically, you could have made £1 million and you wouldn't have to pay a penny of that in tax. It's all tax-free to sell and take out as you see fit. What a fantastic wealth-building vehicle. If it's only a one-off £10,000 lump sum, open your stocks and shares ISA, choose your index funds, have a bit of reading, do a bit of research, figure out which ones work for you. Bear in mind that they all come with a small fee, so make sure it actually balances out as a genuine return, not a paper return that doesn't necessarily play out in reality. Stick it in there. Let time do its thing. Don't log in, don't tinker with it, don't f about with it. Do that homework up front so that you can be confident about what you should reasonably expect to see as a return over an extended period of time. Sometimes it will be down. That's not a crisis. These things happen. Just put the money in and let time do its thing. Of course, one way to turbocharge that return is to put more money in on a weekly, monthly basis, whatever that is. I don't know, based off what you said to me, whether you are in a position to do that or not. You didn't make that clear, and that's absolutely fine. What I would say is, if you can put that in, great, because that money's going to start compounding too, and that will really see a massive difference on your returns. If you were to go into a compound interest calculator now, stick it in Google, put the £10,000 in as the initial investment, set it to a 10% annual return with a variation, we call it, of 3%. It should in theory show you three lines, one for what we should get over a period of time for 10%, one for 7, one for 13. You can really see the difference of that compounding in action. Run the calculation again and do it with an additional calculation of, I don't know, £100 a month contributions, £50 a month contributions, whatever it is. Again, the difference will be absolutely unbelievable. You might not be in a position to put £100 a month in. That's absolutely fine. Think about what you can do just to help you kind of figure out an approximate calculation. It might average out at £50 a month, it might average out at more. And that's on the basis that some months you might be quite flush, you might have had a good month, you can put some more in. Other months might be quite hard up, and you might go several without putting anything in at all. Absolutely fine. The main thing is, for God's sake, leave it in the account. So to summarise then, first of all, it's in a stocks and shares ISA. That's the tax-free vehicle, assuming you haven't used the tax allowance. Do your research on some index funds. Find 1, 2, maybe 3 index funds that match your risk tolerance and are likely to generate you a return that is palatable to you. Do that homework up front. Put it in there. Leave it alone. Thank you very much, whoever it was that put that. I really appreciate it. Put it in there. Leave it alone. Do not do anything with it. Do not faff with it. Do not get all emotional because the market is down for whatever reason. Leave it. When you can, add some more. If you can't, don't worry about it. But I promise you guys, if you've picked the right index funds, you don't have to go around looking for the next Tesla or Nvidia or Apple. You will get a good, consistent return over a period of time. And for someone that doesn't necessarily know that much about how to invest in stocks, that is a fantastic way to get your money really working for you over the long term. I hope you found this useful. If you've got any questions that you want to be featured in the next episode, please send me a message. I promise you, every time that someone sends me one, it will feature in an AMA. This week on the podcast, which is available next week, we're going to be talking about the housing bubble and what I think is going on in the housing market so that you can make some good decisions about your money there. If you thought this was useful, please pass it on to others that might find it so. It's all about helping you get the information that you need to make really good decisions with your money. Wherever you are, whatever you're doing, have a great weekend. Take care. See you soon.